My name is Gnanasekar, a market analyst from Commtrendz Research. A little bit about Commtrendz. We are an advisory firm specializing in commodity and forex markets. We work with corporations both in India and overseas, from top corporates to mid corporates and any organization that who are exposed to commodity price risk. This podcast is to bring more awareness during volatile times like this. With the macro backdrop being so uncertain, it is important to get the views of experts and experienced market analysts to share their experience of similar volatility that they have come across over and over again. But having said that, these are exceptional circumstances and situations which have never happened in the history before. That's why it is very important to bring in years of experience to shed light on what is going on in the recent market developments. However, I would like to say this podcast is not intended to give any buy and sell recommendations of any asset class. Please do check with your financial advisors before acting on any of this information shared in this podcast. So, now to our guest speakers. Here we have with us two veterans of the market, especially one who is a very prominent senior figure in the industry circles, both domestic and global. Introducing you to Mr. G. Chandrashekhar, who was the Commodities Editor of the Hindu Business Line and formerly Economic Advisor to the IMC Chamber of Commerce, and presently an independent member in SEBI's Commodity Derivatives Advisory. He is also an independent board member in a few corporates as well. So his views and opinions are very closely watched by policymakers and industry participants. He is also, incidentally, the co-founder of Commodities Research back in 2004. Personally, I feel if I list all of his accolades, we would just run out of time in this podcast. So I welcome you to this podcast and thank you very much for taking some of your precious time out for us, sir. And we hope to do more such podcasts for the sake of industry participants, and we hope to see you in the near future as well, sir. Our second speaker, Mr. Gnanasekar Thiagarajan. He is the current head of Commodities Research. He started his career with Dow Jones, where he worked with technical analysis legends. Formerly a trader with Scotiabank, he went on to start Commodities Research with Mr. Chandrashekhar and Mr. Yashwant Rao, who was formerly the head of strategies for Reliance Industries oil and gas trading. Gnanasekar also helped develop commodity market participation for MCX in its early stages. And he is a very prominent figure in the print and visual media, opining on the commodity and forex markets, which are widely watched by many viewers in the market. Now, let's get down to the reason why we are here today. Chandrasekhar sir, bullion prices are at record highs again, and you have been watching gold and silver for the past 3 decades. If possible, could you please take us through your journey on gold and silver till date?
Oh, that's an awesome question. I love it. But before that, let me mention, Kaushik, it's such a delight for me to be with this young analyst, Kaushik,
Thank you very much.
young entrepreneur. Do you know what is the lowest price of gold that I've seen?
No.
Mid 90s when I started tracking. Hold your breath. $250 to $260 an ounce.
Oh my God. I wish we
Okay.
went back to
And
those
then,
days.
of course, in a couple of years, by 1998, if I recall correctly, it breached $300, and then it's been moving up. And therefore, the gold's price rise has been an absolutely stellar one over the last 30 years,
Amazing.
from $250 or $260 an ounce. Currently, it's breached $4,000 an ounce.
Wow.
But there have been a lot of hiccup on the way, although over a period of time, gold prices have risen. What is important is the turning point came sometime in 2000, 2001, 2002. In mid 90s, 94 or 95, 96, the government of India liberalized gold import. And that's the time India started to import large quantities of gold.
I see.
There was a huge amount of appetite within India for gold. There's a craze, in fact, I would say,
Right.
To buy gold and have it as jewelry, etc. And people who had a lot of what I would call unaccounted money those days also went for gold, because it is so easy for safekeeping.
Definitely.
It doesn't occupy space, and therefore the demand for gold and therefore gold import volume started to rise rapidly. Then came the time 2000, 1999, 2000, 2001 was the dot-com bubble. That is again the time the world faced a certain financial stress, and gold was seen as a safe haven. And from that time, there has been no looking back for gold, really. That's number one. Because gold was not only a safe haven, not only good for let's say, jewelry, for example, but although it is an unproductive asset. Everybody knows it is an unproductive asset. It doesn't yield any interest.
Yes.
But its supplies are limited. But demand keeps going up. Therefore, from early 2000 onwards, gold was not only a commodity, a precious metal, a commodity, but it also became an investment asset. So gold actually started to have multiple roles, more than one role in the last 25 years. From a commodity, it also became an asset class. And from 2001, 2002 onwards, the prices started to gather momentum. But there was also a time in the late 90s and early 2000 when European Central Bank would actually sell gold, 500 tons a year over a 5-year period. I'm sure it continued for at least 10 years, if my memory serves me right. And that's how they liquidated their gold. But after that, in the last 10 or 15 years, of course, central banks are accumulating, buying and accumulating more and more gold. So gold has had a stellar run over the last 25 to 30 years. But I must again mention, because we are now in this very, very uncertain times, I want to draw attention to what happened in 2012 and 2013.
Right.
In 2012, again, because of various geopolitical issues, very high crude oil prices, economic slowdown, and dollar weakness, and inflation, gold prices went to, if I recall correctly, about $1,800. That was a peak at that point of time, $1,800. And I used to run a weekly column on gold prices, and I'm sure Mr. Gnanasekar used to write his technical analysis for Business Line. Both were very, very closely watched by market participants. And in 2022, late 2022, gold reached $1,800 an ounce plus. And then from January onwards, January 2013, I must say 2012 and 2013.
Right.
2012, it reached $1,800 plus. From early 2013, I was at least able to read signals that the market is waiting for a correction. So gold was equivalent to about 32,000 rupees for 10 grams at that time, for 2012, 2013. And in some of my lectures at the Bombay Stock Exchange and in some of the conferences, I have actually warned that gold is waiting for correction. And there are people who actually laughed at me. They said, gold has been rising for 10 years. How do it will continue to rise for another 10 years? Why do you say it is ripe for correction? But again, it happened Jan, Feb, March. I was then absolutely convinced that it's ready for a correction. That correction came, if I remember correctly, on 14th April 2013. Look at your records.
Right.
Gold crashed. From 1800, it had first come down to below, slightly less than 1700, 1660 or whatever that number. From there, it crashed to $1,200.
Oh my God.
So the big crash. Many people who had bought at 30, 31, 32,000 rupees in India lost their shirt, huge losses, because the rupee price came to 26,000 and all that. So, and then of course it gradually increased to 28,000 or something. And my advice to them was, if you have lost money because of the crash, you now buy at a higher price and average out your losses. So gold has seen this kind of massive volatility. But what at least I have seen over the last few years is that now central banks are not selling anymore, which is very clear, but central banks are accumulating, particularly led by China and of course other central banks like Turkey, emerging market central bankers are accumulating gold. And China is, of course, has a voracious appetite for gold. India also has a voracious appetite for gold, both as an investment asset and as a commodity for jewelry, physical market, etc. And then that is how gold demand has actually improved in the last several years. But coming to this particular current situation that you're talking about, there are multiple reasons why gold is what it is today, $4,000 plus. I think, of course, you have the global economic uncertainty, global geopolitical uncertainty, weakness of the dollar, the ravenous appetite of central bank to buy and accumulate more and more gold. But most important amongst all of this is that I find enormous amount of speculative capital is now sitting on gold. Huge amount of speculative capital. And at the moment, at $4,000 a ton, my sense, my personal sense, although I'm not a trader, I don't hold any trading position. That's a disclaimer I give all the time. My sense is that some kind of a bubble is getting formed.
Right.
And I will not be surprised. Bank of America came up with a forecast. Only 2 days ago, we read that they are looking at $5,000 for now. Okay, but each one has his view. But my strong sense is we need some trigger. I don't know when the trigger would come. Maybe your chart may show when the trigger will appear, but it is imminent. It has to come. You may not be able to time it at this point of time, but it has to happen. But I expect that there would be a big correction. For example, your Israel-Hamas conflict is at least temporarily. There's a ceasefire, an exchange of hostages, etc. What if that were to happen in the Black Sea region? We don't know. And what if Trump decides that he will become less aggressive in tariff imposition? We don't know. So all these, if these challenges, current challenges, geoeconomic and geopolitical challenges get addressed, and don't be surprised if they get addressed sooner than we think. Gold has to correct. Number one, the speculative investors, the institutional investors who are big time into algo trading, it's for them just a touch of a button. They will exit all their large positions absolutely in a jiffy, and that is where retail investors will get caught. Yeah. Particularly retail investors who bought more recently, say under Indian conditions, 1 lakh rupees plus at that level, or say upwards of $3,500 an ounce, as an example. So those people they run this risk of getting caught if there is a correction. That is why I was recently on a television show where I said those who have bought at anything less than $3,500 or less than say 90,000 rupees, it would make sense to sell, exit the market, book your profit, and preserve your capital. But who knows? I think gold is a completely unpredictable market. There are multiple layers, multiple wheels within wheels that work in the gold market. Therefore, I would, as an investor, I'm not an investor, but last week was a investor awareness week of SEBI, where I spoke saying that I would like to caution the investors. They have to be careful. Don't get carried away by this extraordinary bull run. All good things have to come to an end, and even this bull run will come to an end. That was my advice. Yeah.
Wow, that is just simply amazing journey. And now the same question to you, Gnanasekar. So, what has been your journey in respect to bullion price movements historically that you have faced?
Thanks, Kaushik. Actually, my journey is pretty much connected to Sir's because he is the one who is, really gave me a kickstart in the beginning when he mentioned that he started writing for the Hindu Business Line. That was a time, I think, when nobody had too much of an idea about price analysis. I mean, a lot of importance is given to fundamentals and SMEs. But there is one aspect called technical analysis.
Right.
You can use it for price forecast. It's something which I think after market participants saw the success ratio, started really believing in it, and now I think every other person who I've come across as a technical analyst who throws out predictions. I'm very glad that has happened over time. So the importance of this technique has really gone on. So, with my limited experience, what I've seen gold back, I think I started looking at it from 2000 onwards. 99, 2000
Right.
onwards, when it was around $150. And like Sir rightly pointed out, there was a lot of ECB selling. So Europe used to consider it as an unproductive asset and constantly kept selling whatever reserves they had, wherever they needed funds. So now they'll of course be crying for it, but that's karma because they've looted most of this gold, and that's what they're going to. Anyway, that aside, the biggest trigger for gold came after this $150 was when the Twin Tower attacks took place. The US Twin Tower attacked the World Trade Center. So 1 week the financial markets were shut down, and as soon as it opened with a 100 basis point cut by the Fed to prop up the sentiment and economy. So that is when I saw the acceleration of gold from 150 straight away 350, 400, 500. It just kept. So that was the initial big trigger for this. But as Sir rightly pointed out, there are many other incidents that also happened where the uncertainty aspect kept propping up sentiment for gold, which was the dot-com bubble, and then came the Eurozone crisis because there was a big crisis in the Eurozone, and then the Lehman Brothers collapse that happened. So every time I think gold came back as an asset and proved itself that it really works well during uncertain times, both economic and geopolitical. But every time, like Sir pointed out, there comes a point where there is a lot of exuberance, irrational exuberance, and then at that point in time, some kind of froth builds up, and unfortunately, a lot of retail investors get caught at the top end of the market, and funds could easily exit, and they could have a very tough time. So that's an amazing point that's brought out because I see that happening right now. There are one side of market participants that I work with closely. Many of them are short in this market simply because these are new levels. Technically, if you look at it, I wouldn't have the heart to go and buy at these levels. But if you look at it purely from a chartist perspective, these are overdone levels. It has to correct. But every time people are trying to catch a top, they're being unsuccessful because there's so much of buying that's happening from central banks, from investments angle, because it is not just jewelry. So a lot of investment inflows that are happening through ETFs, through different kind of funds. And the equity markets, all this trade tensions that are happening is rubbing off on the equity markets, which are unable to perform. And therefore, a lot of investment is moving towards gold because they see it, rising continuously. So that's pulling market participants more and more into gold. But that is a problem. When so much of froth builds up, it's ripe for a very big correction. But that's still not in offering. But quickly, I just wanted to come up with just one slide which will draw some parallels as far as what's happening in silver and in a agri commodity. Very strange, but then I just wanted to draw that parallel. So what we see here in the screen, basically silver prices on the left and coffee on the right. So I've taken a very long historical chart. It's like from 1970s. So you can see that silver has, tried breaking the $50 level at least twice in the past. And then now you've break. Similarly, on the right hand side, if you look at coffee, right from 1970s, there have been spikes like this to $3, $3 a pound. That's the price of coffee. Now, unsuccessfully, every time it goes there, then the whole thing dies down because of weather. It's basically because of the frost risk in Brazil. That every time coffee shoots up because of that, and then it corrects off. It's a cyclical. But the point is, when it broke this long-term resistance at $3, everyone believed it's going to do the same thing. It'll come back the same way it did last time and the time before. But the interesting part is that it continued the bullishness, and the level which it broke, the 30-year resistance, became a support. Every time it came there was huge buying that came in. And similarly, the same situation is what is being seen in silver. 50 is sort of going to be a base now for any kind of an up. That's the it's not a price forecast, but it's basically something which I've seen over and over again in various other commodities. So I also pointed out earlier in the program that there are other agri commodities like this, like cocoa, which also took off to all-time highs. But this one is very important because I can see a lot of technical similarities between coffee and silver. And Decode point at 50 is going to start building a base. Exactly not 50, but it could be between 48 and 50 or 45 and 50. That zone is going to be a very, very strong support zone for silver. And for one of the main reasons is that there's a shortage of silver also. So that's basically where we are right now. And back to you. Sir, please, you can.
Yeah, no, on silver, first I want to compliment you, Gnana. It's extraordinary. There's a story here actually. And the kind of correlation, the kind of similarity in movement. Although coffee has been more volatile than silver, but it's in its very nature. So while you were talking about silver, there are 2 or 3 things. One, in the last 5 years, world silver market is in a state of deficit. For 2025, the deficit is estimated at 6,000 tons. Number one. Number two, on the demand side, it's absolutely robust. Because of energy transition, there's a huge demand for silver in electrical and electronics applications, in mobility, in solar panels, etc. So huge demand. And in addition to that, obviously, speculative capital obviously builds its positions when there is a demand-supply mismatch. And therefore, it has an exaggerated impact on prices, which is what we see both in gold and silver. But silver is now more of an industrial metal rather than a precious metal. And therefore, I agree, silver probably has made a good base. Gone are the days of 25 and $28 now. It'll be upwards of 35, or even it could be upwards of 40, primarily because of its industrial character and industrial application. And this energy transition application is not short term. It will run over the next, say, 15, 20, 30 years. Therefore, it's a great opportunity for silver. Sorry, go ahead.
Yeah. Back to your question.
That was really amazing to hear. And what a journey you both have been through in the bullion markets. So we can move on to the next question now. Chandrashekhar sir, What is different this time compared to what has been going on in the past? Please let us know your valuable insights.
So there are multiple drivers for the bullion market, gold and silver market globally, and different drivers have or exert their influence with different levels of intensity. Okay? Therefore, not all drivers come together and exert their influence. Selectively, whether it is inflation or the dollar weakness or geopolitical challenges like a war-like situation or geo-economic problem, or on the demand side, something huge spike in demand. There are various factors or supply side challenges. But currently, in this current situation, most of those market drivers have come together. Earlier, if there were four or five, six drivers, only one or two would actually operate with a certain intensity and push prices up. But currently, multiple drivers are operating in this market simultaneously, whether it is, as I said, geo-economic or geopolitics or the dollar or central bank buying, safe haven demand, all of that together. Therefore, that the effect of the combination of all the multiple drivers of the market, uh, and over and above that is the role of the speculative capital, which exerts an exaggerated impact, has taken prices to this level, and therefore this is somewhat unlike the previous editions of the price spikes that we have seen. But I'm certain. I believe this too shall pass. It's not going to stay there forever. So this will change. When it will change, we still don't know. Number one. Number two, we should also remember the physical demand. Physical demand has now become a secondary factor as far as gold is concerned. Is very substantially weak, particularly in price sensitive markets like India. And therefore people are buying gold during festival time for weddings, etc. But it's all much lighter in weight than it used to be. So people just can't afford. So therefore there is a certain demand destruction. The sorry, it is what is called price elasticity of demand. Higher prices will lead to some amount of demand destruction. This is happening not just in India, in China also. Retail sales of physical jewelry is actually quite muted. But central bank purchases and all of that is taking prices up. And secondly, this speculative capital, I always think, and I know it is very fickle in nature. That capital has no affinity. That capital has no commitment. That capital can move from one commodity to another,
Right.
one asset class to another, one market to another in a jiffy. Wherever they find money, they will move. Therefore, gold used to have committed bulls, committed gold bulls. Now, the class of that committed gold bulls is actually much smaller in terms of the number, and therefore institutional investors who are basically speculative investors are dominating the market, and they will at some point of time move out of it, and therefore that's why I keep talking about caution. The market has to exercise caution. When you have a lot of speculative ladder that is gathering, that ladder can disappear very soon, and that's what retail investors have to be cautious about. This is what I'm thinking. Yeah.
All right, Mr. Gnanasekar. Now the same question to you. So what do you feel is different this time compared to the previous experience you have faced in the bullion markets?
Well, what is very prominently different this time is the investment class is out in a big way. And I talked to many of these dwellers also. So, I mean, people are not bothered about the rate. They're just bothered about whether they will get the delivery or not. So the physical delivery aspect is what has changed the complete equation at this point in time. And that's seeing a mad rush towards bullion, and then it's proved it's a safe haven asset. So I think that's that. But having said all this, any asset class, like Sir rightly pointed out, this too shall pass. This is like what is going to sustain forever. So right triggers come into place. A substantial correction could set in. But the problem is right now it's like a train without a brake. We really don't know where it's going to go and stop. And if you go against it, then you're going to get hurt for sure. So these are the times when risk management is very important. Stop losses have to be adhered to, though it's so painful to see stop losses getting triggered, especially for retail investors, because they tend to get carried away with all the headlines that we see, and their confidence is at the peak. They don't understand the concept of undervaluation and overvaluation. So the present scenario, though it is, I wouldn't say it's undervalued, it's certainly overvalued at this point in time. So one needs to be very cautiously optimistic. And in fact, instead of seeing money, on an NTM basis, one should actually take it into the account by actually booking some profits. Though I'm not recommending that, I'm saying that if one were sitting on decent profits, instead of looking at a very long-term story where so many factors come into play later, just start booking profits at different levels and average the profits out, just like how we average when you enter also. So that's the assessment of the present situation that I guess at least.
Now, I also want to mention in the current prices and the prices of the last 1.5 years, 2 years, in fact, I must mention, there is a certain risk premium built into gold. And this risk premium was probably about $200, $250 until about 2 years ago. And I sense that this risk premium is now far higher. And this risk premium is primarily driven by the two wars, Black Sea region and the Hamas-Israel conflict, plus the tariff-related uncertainty, US tariff-related, which is leading to geoeconomic instability in some manner. So both geopolitics and geoeconomics are working together, and then therefore for this risk premium to decline, if peace were to break out, and it is at least there are signals that it is happening in Hamas-Israel conflict. So I don't know if it is reflected in gold prices. I'm not very sure. But if the Ukraine-Russia war also were to stop for some reason, and if, as I said, Trump better sense were to prevail, and he wants to tone down his aggressive tariff stand, that will lead to a very sharp decline in the risk premium, and therefore a correction in the market. But all these are big ifs. If yes, possible, because we need to build scenarios. The market is not going to work in a straight line. We need to build scenarios. What if this happens? This is the result. If this happens, this is the result. I think we need to keep building scenarios and have a proper, robust risk management policies.
Right. That was very eye-opening, sir. Thank you very much. So I will move on to the last question of this session today. So without making any price forecast, sir, what is the future path for bullion and the industry?
Oh, that's a great question. Two things. One, at least in emerging markets like India, for example, bullion will continue to remain a favorite for a very large number of people. There's no doubt at all. Because at least in India for sure, South Asia for sure, bullion has mythological, historical, economic, social,
Yes, sir.
and other implications for people. And therefore there's a great attraction towards gold, and there is a lust, in fact, lust for gold in some way. This is not going to go away anytime soon. Therefore, it will continue. Therefore, the physical demand part of it,
Right.
marriages happen, festivals happen, child birth, gift to children, all of that will involve gold. Therefore, gold will continue to remain a favorite. Whether it will continue at this price or lower price or higher price, we are not on that. But the demand for gold will continue, at least in India and in South Asia, into the foreseeable future, into at least next one more generation. Because look at the US, look at Europe. They also were consuming gold until about 70, 80, 100 years ago as jewelry. But as education improved, as economic status improved, as per capita incomes improved, and as other investment opportunities improved, now a young person like you you would rather buy an expensive iPhone or whatever other gadgets instead of buying whatever a gold chain or whatever it is. Therefore, the opportunities are far greater. Therefore, it depends on the income level. It depends on cultural background. It depends on other opportunities for availability of other expenditure avenues and investment avenues. And therefore, but very clearly, gold will continue to remain in fashion in South Asia, in India for sure, at least over the next 15, 20, 25 years. That is for sure. Silver, as I said, is becoming more of an industrial metal, and its own use and utility will be increasingly industrial, and it'll continue to find favor. There'll be huge demand for silver going forward. There's no doubt.
And the same question to you, Gnanasekar. So, what is the future path for bullion and the industry that you feel?
To me, there are two key aspects. One is the dollar debasement that's happening.
Right.
The reserve status that it's basically losing to gold, and being a fiat currency or an alternative currency was just a concept some time back, and now it's becoming a possibility. So will it really happen? I have my doubts whether it will happen in the next 10 years, because the US is not going to so easily lose up. The deficits are loading. It's something that they need to work on. Otherwise, this control, and eventually what they.
Sorry, Gnanasekar. Please go through that once more. I feel your voice is breaking up.
There's some background noise. Yeah.
Not from my end.
No, it's all clear when I'm speaking. So when you were going through your last paragraph, we had some technical interference. So could we just take it up again?
So there are two aspects that would continue supporting bullion prices going forward. One is the dollar debasement, where dollar will ideally is expected to lose its reserve status. If you look at even India, the maximum reserves is in dollars. The second was euro, and third was gold. But it's changed this year or so. Gold has overtaken euro. This is happening across the board. Almost all central banks, you can see the reserve churning happening towards gold. Whether it will become a similar situation like what happened before Nixon when he abolished the gold when it was fixed to the currency. So that will come back very likely, because the way China is accumulating gold, it looks like they are heading towards that path. Yes, that could keep gold prices very, very steady and continuously well built at all levels. But let's not get carried away too much, because it's a zero yielding asset. A dollar bond gives you an interest. So therefore, central banks use it or hold it as a reserve currency. And similarly, other currency and other currency bonds, they all give a certain return in fixed
Right.
income, but gold just doesn't. So it's only a potential return that central banks keep accumulating. So that threat is there. That the minute they see gold is not going to yield that kind of a return, then comes the problem. But it's too early to say at this point in time when something like that will happen. But yeah, that's to me the fundamental undercurrent as far as gold is concerned. Like Sir said, silver is a completely different ballgame now. It's an industrial metal, so on both sides it's going to get support. So it's going to go.
Wow, that is just simply amazing. So I think with this, we shall conclude today's podcast. The amount of insights that I and all the participants have gained here today is just simply immense. So once again, a big thank you for coming in and sharing your views, Mr. Chandrasekhar sir and Mr. Gnanasekar as well. So in foggy times like this, your words are cutting through like a lighthouse, guiding the market participants to a good outlook of the price in near future. So I really thank you for your expert opinion on that, please. So you were saying something. Not able to get you on audio, sir. Thank you very much, sir.
Thank you. God bless.
Yeah.
We need that, sir. We need that. This
Right. So now with this, we will close this podcast. And thank you very much for viewing our podcast. And we really hope you would tend to subscribe to our channel, where you would get more regular updates like this in the near future. And it won't just be restricted to bullion. We will also be including different commodities in the agri, edible oil, energy sector. So please keep an eye out and wait for our updates. And thank you very much.